Hi, Tom Lydon here in Chicago at the Morningstar ETF Conference. I'm here with Matt Goulet and Darby Nielson from Fidelity. These gentlemen are really behind the ETF efforts at Fidelity, and congratulations on all your success, gents.
Thanks, Tom.
Thank you.
So, Darby, let's talk a little bit about your smart beta strategies, because it's not just a smart beta strategy like everybody else. I mean, Fidelity's had a great history of active management. How did this develop?
Yeah, so we do have a great history of active management. I would say, we're pretty effective at it. We're more traditionally known as a fundamental investment shop, I would say. But the truth is, factors have been integrated in our active investment process for many, many years now. And so how do we do that? Well, I have a team of quants that work for me. We have 20 quants, and we're actually integrated in the investment process with the rest of the fundamental investors. And we do that because I have a quant with every team, with the small cap team, with the emerging markets team. And so over the years, we've built a 3,000 factor library. We've built models for all of our portfolio managers, and all of that has been a collaboration. And we've learned from our fundamental partners. It's informed our factor selection, how we decided to construct the portfolios. We've learned this all over the years. I built some of my own models with some of our fund managers. So all of that informed the decisions we made and how we designed these things to achieve the three objectives we wanted to achieve, which are targeted exposure to the factor, reduced unintended risks to other things like sector effects or a size effect that may be unwanted, and then thirdly is competitive performance. And like you said, it's been a year, but I'm excited to say they've performed as designed.
Great, excellent. So walk through the factor strategies that you offer, and then we're going to get a little bit into how advisors are using them.
Sure. Yeah, so we launched 6 factor strategies last September. It'll be a week, it'll be a year and a week. And those 6 are 2 dividend-focused strategies where the outcome for investors is yield, right? So we did 2 of them. We have a high dividend strategy, and then one that's a little differentiated, which is the Dividend ETF for rising rates, which is designed to perform better in a rising rate environment. And then thirdly, we have a low volatility strategy, which is really, I think, more for risk control, risk reduction. And then 3 others for more strategic excess return over time, which are value, momentum, and quality ETFs.
Excellent, excellent. So rounded it out, nice suite. Matt, when you're working with advisors and institutions and they see now you've got dividend choices, you've got single factor choices, how do they incorporate them into the portfolio?
Absolutely. So since the launch last September, one of the things I've found is that advisors are really gravitating towards the dividend suite that Darby's team built out. And if you look back in history, we've had dividend ETFs in the market for over 15 years, but the majority of them are concentrated and looking at individual stocks and how many years they've increased dividends, whether it's 5 years or 10 years or 20 years. We took a little bit of a different approach. We started with yield, which is what the advisors are really looking for, and then built the methodology around the yield of the underlying portfolios. And what you get is more exposure to a sector like technology that may not have the history of increasing dividends, but certainly is a big dividend paying component of the marketplace today. On top of that, we did Dividend ETF for rising rates. So we recognize that most people are concerned buying dividend stocks in a rising rate environment. Why not build a methodology around a dividend strategy that also layers on some characteristics that work well in a rising rate interest rate environment?
Okay, and finally, how would you select an individual factor? Say you have a high correlation of the S&P 500. Is it what's going on in current economic conditions, and certain factors tend to do better during times like these?
Yeah, I could go to Darby for that.
I think it depends on the outcome that the investor is looking for. Like I mentioned before, I mean, if shareholders are looking for yield, then you want one of the 2 dividend products.
Yeah.
If it's for, in a portfolio construction context, to reduce risk, then it's a low vol. But if you're looking for over time, capital appreciation, some excess return strategically, then I think you want to think about a mix of maybe value, quality, and momentum.
Gotcha. And if anybody wants to get more information, the website is?
Fidelity.com.
Fidelity.com. Excellent. Gentlemen, thanks for coming by. Enjoyed
Great,
it.
thanks for having us.
Thank you.
Thanks, Tom.